Did you know California's population is about 40 million? And while that doesn't mean 40 million homeowners, it does mean millions of families could be hit by the same nightmare in the next 12 months. Your home insurance gets canceled, and suddenly your mortgage is at risk. Here's the scary part. This isn't just about wildfires anymore. It's about a system where insurers are pulling back, last resort coverage is exploding in size, and your monthly payment can jump without warning. In fact, California's FAIR plan, the backup insurance many people never plan to use, has surged to hundreds of thousands of policies, and experts warn the market is becoming a national warning sign. So the big question is, if your home becomes uninsurable, can you lose everything even if you paid on time? Stay to the end because the 10 reasons behind this are more shocking than you think. Number 1. Uninsurable homes. Imagine receiving a letter in the mail saying that your home is no longer covered by your insurance policy. No warning, no prior notice, just a simple statement, policy non-renewed. You might think, I'm a responsible homeowner. How could this happen to me? Well, it's happening to thousands of Californians every year, and the reason is more complex than you might expect. Uninsurable homes are becoming a growing concern in California, and it's not because your property is in poor condition. The reality is, insurance companies are shifting their focus from the physical condition of your house to risk assessments that are based on environmental factors. Wildfires, floods, and other natural disasters are wreaking havoc on the state, and insurers are no longer willing to take on the risk in areas deemed high risk. But here's the kicker. It's not just about disasters. Homes in certain zip codes are now considered uninsurable due to the proximity to wildfires, flood zones, or earthquake faults. And without insurance, your mortgage lender could step in and force you to get lender-placed insurance, which is often more expensive and offers less coverage. This isn't just a distant threat, it's happening right now. In fact, as of 2025, over 100,000 California homeowners had to turn to the FAIR plan, California's insurer of last resort, which often comes with higher premiums and coverage limits. If you live in an area with high wildfire risk or prone to flooding, your home may already be on the path to becoming uninsurable. So what can you do to protect yourself? Well, it starts with understanding your insurance policy and being proactive before the situation spirals out of control. Stay tuned for more insights on how to avoid falling into this trap. Number 2. The FAIR plan. When private insurers pull out of high-risk areas, the FAIR plan, fair access to insurance requirements, becomes the last resort for homeowners in California. But while this plan might seem like a safety net, it comes with significant drawbacks that could leave you in a worse financial situation than you were in before. The FAIR plan was designed to provide basic insurance for homes that can't get coverage from traditional insurers due to high risks like wildfires or flooding. However, basic is the key word here. The coverage it provides is often minimal, and in many cases, it may not be enough to fully protect your home from disasters. You may find yourself paying a higher premium for a plan that only offers limited protection, meaning you'll likely need to buy additional policies to cover areas like personal property, liability, or living expenses if your home is uninhabitable. Here's the shocking part. FAIR plan premiums can be 2 to 3 times higher than traditional insurance policies. On top of that, the plan doesn't offer the same extensive coverage or customer service that you'd expect from a standard insurer. While this plan may provide coverage in the short term, it's hardly a long-term solution. Homeowners in California have started realizing the long-term financial burden of relying on the FAIR plan. The FAIR plan trap is becoming more common, where homeowners feel stuck paying exorbitant premiums while still not being fully protected against major disasters like wildfires. So if you're relying on the FAIR plan right now, it's time to start thinking about your next steps. Can you afford the high premiums? Are there better options available? The answers might surprise you, and staying informed could save you from facing a financial nightmare down the road. Number 3. Lender-placed insurance. What happens when your home insurance policy lapses or is canceled? You might think you have time to shop around for a new policy or find another insurer, but lender-placed insurance could step in and completely catch you off guard. This type of insurance is what happens when your mortgage lender buys a policy on your behalf because you no longer have an active homeowner's policy. At first glance, lender-placed insurance might seem like a good backup plan. It ensures that your lender's investment is protected. But here's where it gets tricky. This coverage is not designed to protect you, the homeowner. It's primarily designed to protect the lender's interest in your property, and it usually comes with higher premiums and limited coverage compared to traditional insurance policies. What makes lender-placed insurance dangerous is the cost. If your insurance lapses, the lender may charge you for this coverage, and the premiums can be much higher than what you were paying before. In many cases, homeowners can end up paying 2 to 3 times more for this type of insurance. And the worst part, you often don't have any say in the provider or policy terms. Your lender chooses it, and you're stuck with it. In addition to higher costs, lender-placed insurance often offers less comprehensive coverage than a standard policy. For example, it may only cover the structure of the home, leaving you without coverage for personal belongings or liability. If your policy lapses, you could find yourself stuck with these expensive and limited policies for months or even longer, draining your savings and leaving you vulnerable. The good news is that this doesn't have to happen if you stay proactive about keeping your insurance up to date. Action step. Always know the renewal dates of your policy and talk to your lender about their specific requirements. Avoid the trap of lender-placed insurance by staying on top of your coverage. Number 4. Premium shock. Imagine getting your insurance renewal notice and seeing that your premium has skyrocketed. It's a reality that many California homeowners are facing, as premium hikes have become a common trend in the state. Insurance companies are raising premiums at an alarming rate, and this is largely due to the increasing risk associated with natural disasters like wildfires, floods, and earthquakes. The cost of rebuilding and repairs after a disaster has increased dramatically, and insurance companies are trying to recover their losses by charging higher premiums. But here's the problem. Premium shock isn't just a minor bump in costs. It's a dramatic increase that can push homeowners into a difficult financial situation. In some cases, premiums are rising by hundreds of dollars a month, and sometimes even more. For homeowners already struggling with the high cost of living in California, these hikes can feel like an impossible burden. It's not just homeowners in high-risk areas that are affected. Even properties outside of wildfire zones or flood-prone areas are seeing higher premiums. Insurers are tightening their belts and spreading the costs of past disasters across their entire customer base. This means that even if your home hasn't been directly impacted by a natural disaster, you could still face significant premium increases. For homeowners on fixed incomes or those already stretched thin with their mortgage, these rising premiums can lead to serious financial strain. It's not just the premium itself. Higher premiums often lead to higher monthly payments, which can make it difficult to keep up with other bills. In some cases, homeowners might even have to choose between insurance and other essentials like food or medical expenses. Practical move? If you're facing a premium hike, don't panic. Shop around for better deals. Consider increasing your deductible to lower your monthly costs and explore options to make your home more disaster-resistant to reduce your risk and potential premiums. Number 5. Underinsurance risk. Imagine this. A massive wildfire sweeps through your neighborhood, and while your house survives, it sustains significant damage. You're relieved that your insurance policy covers most of the rebuild costs, but as you start the process, you realize something shocking. Your insurance coverage is not enough to fully restore your home to its original state. This is the hidden danger of underinsurance, when your home is covered for less than what it would actually cost to rebuild after a disaster. While many homeowners think their policy is sufficient, rebuild costs often exceed the amount of coverage they carry. This is particularly true in areas where construction and labor costs have surged in recent years, making reconstruction more expensive than ever before. Underinsurance is becoming a bigger problem in California, especially in areas affected by frequent wildfires and floods. When homes are destroyed or severely damaged, the cost to rebuild, considering everything from materials and labor to local building codes, can be much higher than what your insurance policy would pay out. This means you could be left with significant out-of-pocket costs just when you can least afford them. Here's where the problem gets even worse. Insurance policies often only cover the cost to rebuild the structure of the home, leaving you without sufficient coverage for things like personal property and temporary living expenses while your home is being rebuilt. So, if you haven't updated your policy recently or made sure it reflects current market conditions, you might find yourself underinsured without realizing it until disaster strikes. Practical move? It's critical to review your rebuild cost estimates and compare them to your current policy limits. Get an updated replacement cost estimator from a trusted professional to ensure that your coverage is adequate. Don't wait for a disaster to reveal that your insurance falls short. And that's a wrap on why 40 million California homeowners could be facing disaster by 2026. What do you think? Are you at risk of losing everything? Drop your thoughts in the comments below, and let's get the conversation started. Don't forget to check out our previous video for more in-depth tips on protecting your home. We put a lot of effort into these videos, and your support means everything. So hit that subscribe button. It's just one click, and it helps us keep bringing you valuable content. Number 6. Paper protections. In the face of escalating risks, California lawmakers have stepped in to create temporary paper protections for homeowners, such as moratoriums on insurance non-renewals and rate hikes. These measures are designed to offer some relief when wildfires, floods, or other disasters strike. However, as helpful as they might seem, paper protections are not a long-term fix for the deeper issues plaguing the insurance market in California. The truth is, these protections are just that, temporary band-aids on a much larger, more complex problem. While a moratorium may prevent insurers from dropping policies immediately after a wildfire or severe storm, it doesn't actually solve the problem of climate risk pricing. It doesn't guarantee that homes in high-risk areas will ever be insurable again once the moratorium lifts, or that premiums won't spike once the protective measures expire. Many homeowners mistakenly believe that these protections give them long-term security, but the reality is they only buy time, often not enough time to secure more sustainable coverage. When the moratorium ends, homeowners are still left with the risk of premium increases, non-renewals, or worse, lender-placed insurance. These short-term fixes do nothing to address the underlying risk that insurers are so wary of, climate change and its devastating effects on homes and communities. For homeowners relying on paper protections, it's important to understand that you can't rely solely on the hope of future legislation or temporary relief. You must take proactive steps to secure your property's future, such as upgrading your home to reduce risk, shopping around for insurance regularly, and exploring alternative coverage options before the protections expire. Practical move. If you're covered by a moratorium, use that time wisely. Start searching for more permanent solutions and begin making your home more disaster-resistant to ensure you're not left vulnerable when the protections end. Number 7. Climate risk pricing. The future of home insurance in California is being shaped by one of the most significant trends of the 21st century: climate risk pricing. This is a shift in how insurers evaluate your home's insurability, with an increasing focus on the climate risks your property faces, whether that's from wildfires, floods, earthquakes, or other natural disasters. And here's the key part. Climate risk pricing is no longer a distant threat. It's happening now, and it's impacting homeowners across the state. What makes this trend so important is that insurers are now using data-driven models to predict the likelihood of climate-related events occurring in specific areas. These models look at factors like the frequency of wildfires, flood risks, and future climate patterns. Based on these predictions, insurers are adjusting premiums and even refusing to renew policies for homes located in high-risk zones. The result? Higher premiums for homeowners in vulnerable areas, and in some cases, the complete loss of coverage. California is a bellwether state for climate risk pricing, and the effects are already being felt. Homes that were once considered safe and insurable are now being priced out of the market due to high wildfire risk or flooding threats. This means that more homeowners are turning to government programs like the FAIR Plan to keep their homes insured, but at the cost of significantly higher premiums and limited coverage. But the bigger question is, how can you protect yourself? If you live in an area that's being heavily impacted by climate risk pricing, your insurance premiums could rise dramatically, leaving you vulnerable to lender-placed insurance or worse, uninsurable homes. Practical move. If you're in a high-risk area, consider making disaster-resistant upgrades to your home, like installing fire-resistant materials, reinforcing your foundation, or creating defensible space. This can help lower your climate risk profile and keep your insurance premiums manageable in the long run. Number 8. Foreclosure pressure. As insurance premiums rise and coverage options shrink, many homeowners in California are facing a new financial threat: foreclosure pressure. While we often associate foreclosures with missed mortgage payments, the reality is more complicated. For many homeowners, the rising costs of insurance premiums, property taxes, and repairs can create a snowball effect that makes it harder to stay current on their mortgage payments. In some cases, these rising costs lead to delinquencies and, eventually, the loss of their homes. When premiums spike, homeowners are left with a difficult choice: pay for insurance or put food on the table. Unfortunately, this kind of pressure is only increasing. In fact, reports indicate that foreclosure rates have begun to climb again in some areas of California, with more homeowners falling behind on payments due to the escalating costs of home ownership. As insurance rates increase, homeowners who are already struggling with their mortgage payments are faced with even higher monthly bills. This can lead to delays in mortgage payments, triggering the chain reaction that eventually results in foreclosure. But that's not the only problem. If you can't keep up with rising insurance premiums, lenders may also impose lender-placed insurance on you, which comes with its own set of costs, further exacerbating the financial strain. Additionally, for those who experience a natural disaster, the financial burden can be even worse. A wildfire or flood can cause massive damage to a home, and the temporary living expenses while the home is being repaired can put even more pressure on homeowners to keep up with their financial obligations. Practical move. To avoid this trap, it's crucial to build a financial buffer. Set aside savings for unexpected costs, review your mortgage and insurance policies regularly, and consider insurance alternatives to keep costs in check. Don't wait until a crisis hits. Prevention is key. Number 9. The lock-in effect. If you've ever thought about moving to a new home, you may have encountered the lock-in effect, a phenomenon unique to California homeowners, largely driven by the state's property tax system. Thanks to Proposition 13, homeowners are protected from significant property tax increases. While this is great for those who stay in their homes for many years, it creates an unintended consequence. Homeowners are often stuck in place because moving would mean a massive increase in property taxes. Here's how it works. Prop 13 caps property tax increases to a maximum of 2% per year, regardless of how much the market value of the home increases. This provides long-term homeowners with tax stability, but it also penalizes those who want to move. If you sell your home and buy a new one, your property taxes will be reassessed at the market value of the new home, which can lead to significant hikes. For example, a home purchased for $400,000 in the 90s may only have a property tax bill of $3,000 per year, while the same home sold for $1.2 million could come with an annual property tax of $12,000 or more.
This lock-in effect makes it financially difficult for many homeowners to downsize or relocate, even when their home becomes unaffordable due to rising insurance premiums, taxes, and maintenance costs. In many cases, people end up staying in a home that no longer fits their needs simply because they can't afford the property tax increase that would come with buying something new. Practical move. If you're considering moving or downsizing, it's crucial to understand the financial implications of Prop 13. You might want to explore options like property tax transfers or discuss potential solutions with a real estate professional who specializes in navigating California's tax laws. Make sure you know exactly how your move will impact your finances before making any decisions.
Number 10. Chain reaction disaster. In California, a single disaster, whether it's a wildfire, flood, or earthquake, can trigger a chain reaction that leaves homeowners financially devastated. It's not just about the immediate damage to your property. The aftermath of a disaster can send homeowners spiraling into a sequence of events that's hard to escape from. The costs of recovery, coupled with insurance claims delays, temporary living expenses, and job disruptions, can quickly overwhelm homeowners, leaving them vulnerable to losing everything they've worked for. First, the physical damage. If your home is severely impacted, rebuilding costs can skyrocket. Even if you have insurance, claims disputes or delays in the claims process can add weeks or months of uncertainty, leaving you in a precarious financial position. In the meantime, you may need to find temporary housing, which isn't always covered by your policy, especially in high-demand areas after a disaster. Then there's the job disruption. When disasters strike, businesses in affected areas often face closures or slowdowns. This can lead to lost wages or even a permanent job loss, making it even harder to keep up with mortgage payments or other financial obligations. For those with no savings or emergency fund, the combination of lost income and mounting bills can push them to the brink. This chain reaction of events doesn't just affect the home itself, it impacts every aspect of life: your job, your family's well-being, your financial security. And in the worst cases, it can force homeowners to sell quickly, often at a loss, to avoid further financial hardship. Practical move. The key to surviving a disaster without falling into this financial trap is preparation. Create a disaster plan, ensure your insurance is up to date, and set aside emergency savings for situations that may disrupt your life. The more you prepare in advance, the less likely a single disaster will set off a domino effect that could cost you everything. As we've seen, California homeowners face a storm of challenges in the coming years, from rising premiums and uninsurable homes to the very real possibility of foreclosure and property tax lock-ins. The path ahead can seem overwhelming, but the truth is, knowledge is power. By understanding these threats and taking action now, you can protect your home and secure your financial future, even as the landscape continues to shift. The key takeaway here is that you can't afford to sit back and wait for these issues to hit you. Whether it's rising insurance premiums, lender-placed insurance, or the increasing threat of climate risk, it's important to be proactive. Regularly review your insurance policy, ensure it reflects the current rebuild costs, and consider disaster-resistant upgrades to reduce your home's risk. If you're relying on temporary protections like the FAIR Plan or moratoriums, take advantage of that time to shop for alternatives and explore other options. Most importantly, don't wait until it's too late. Build a financial buffer to withstand rising costs. Set aside emergency savings and document your home's value and contents. Preparation now can prevent a disastrous chain reaction that may otherwise wipe out years of savings. Finally, stay informed. Keep an eye on new laws, regulations, and changes in the market that could affect your insurance options and home ownership rights. By staying ahead of the curve, you'll be better equipped to handle whatever challenges come your way. Protecting your home is about more than just keeping the roof over your head. It's about securing your future. So take the steps today to ensure that your home remains a source of stability, not stress. Because in California, the future of your home is in your hands.